Good morning friends, welcome to The Point. In this video, we'll try to understand a very simple concept related to economy, which is quantitative easing. So let's start with the video. So as the name suggests, it is easing of the quantity. Yeah. So just a second. Yeah. So quantitative easing is an unconventional monetary policy. So why do we call it unconventional? First thing, monetary policy we have already studied in the previous video. Monetary policy is such a tool which the central bank uses to regulate the supply of money in the economy. And why this is called unconventional is the conventional monetary policy uses tools like CRR, SLR, and repo rate and the reverse, which is called the key interest rates. So this quantitative easing is something out of the purview of the conventional monetary policy. So that is why it is termed as unconventional monetary policy used by the central banks to stimulate the economy when standard monetary policy has become ineffective. So there are certain times in an economy where all the tools which a central bank uses becomes ineffective and nothing can be done to spur the economy again. So that is where this quantitative easing comes in. In this case, what a central bank does is it implements quantitative easing by buying specified amount of financial assets from the commercial bank. Now what happens is so there's a central bank and these are the commercial banks. So what is mentioned is central banks go to these banks and buy financial assets. So when the central bank buys assets, so the assets flow in this direction, and in return what central banks give to the banks is money. So whenever you have to buy something, what in return you give is the money. So same as this in this case, central bank goes to the banks, buy the financial assets, and in return gives money to the banks. So now the banks are loaded with the money which they can actually lend it as a loan to the people in the market, and the interest rates, because there is much money in the market, the interest rates falls down and the more and more people are attracted to avail the loan, and that is how the supply of money is increased in the economy. So we'll read it once again. A central bank implements quantitative easing by buying specified amount of financial assets like this from commercial banks and other private institutions. It's just not that the commercial banks participates in this, they also go to the private institutions and buy the assets from them as well, thus increasing the monetary base. So the banks have now more money to lend, and whenever the banks have more money to lend, the interest rates automatically goes down and more people come in to ask for money, and that is how they use it for their personal purpose, or let's say investment purpose, or whatever it is. So this is how the supply of money is increased, the investment is increased, and this cycle starts. Now, what are the effects of quantitative easing? As simple as that it increases or eases the money supply in the country. As we have studied via this example, the money becomes more easily available, as in the long-term interest rates gets reduced. Once the loan becomes cheaper, more and more people reach out to take loans, and thus money supply is increased in the country. When the money supply is so more and more people are taking loans, so they are using it for different purpose, maybe as investment, maybe for personal demands or consumption, which you say, or maybe starting a new business. So all of this is creating an effect where the rotation of money in the economy increases. Let's suppose if a person is taking loan and starting a new business. So for starting a new business, he'll get a land or a factory or buy some assets for it and then hire labor. And for this he has to spend some money. He has to pay salary regularly to the laborers and pay rents and electricity bills. So what is this doing? What is the effect? Is that the money is again coming in the economy, the rotation has started. So this is the primary effect of quantitative easing, and for this main reason the central bank resorts to quantitative easing as to spur the economy again. Now we'll understand this again with this diagrammatic representation. So how it starts is that central bank goes and purchase of securities by the central bank, which in turn gives money to the commercial banks. So there's a lot of money with commercial banks, due to which it lowers the interest rate on borrowings. So when the interest rate is down, more corporation and people approaches the bank to borrow the money, which they in turn spend and maybe start a business, which leads to job creation, as I have explained. And what does it result into? It results in economic expansion. So to tell you friends, when the subprime crisis happened around 2008 and 9 in America or US, so after that the Central Bank of America, which is Federal Reserve System, resorted to quantitative easing to bring the economy back on track. So yeah, that was something which was very heavily used by the US Central Bank, and which actually helped in reviving the US economy. So I hope this very small concept is clear to you by now. This is all for the today's video. Thank you very much.